When the Federal Reserve does something it has not done in almost a decade, most investors do not even notice. On July 29th, 2026, the FOMC voted 9-3 to hold the federal funds rate at 3.50 to 3.75%. That headline alone tells you almost nothing. The real story is in the 3 no votes, because Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas did not dissent because they wanted lower rates. They dissented because they wanted to raise rates by a quarter point right now. That is the first unified hawkish dissent on the Fed since September 2016. So before you look at where gold and silver are trading today, ask yourself the smarter question, which is why 3 sitting regional presidents just told the market that holding steady is already too loose. Stay with me through the mechanism, because once you see the chain that connects the Middle East to your silver position, you will not read a Fed headline the same way again. Here is exactly where we stand as of Friday, July 31st, 2026. Gold is trading around $4,086 an ounce, down about 0.42% on the day, though it remains up more than 21% from a year ago. Silver is trading around $59.08 an ounce, up about 1.5% on the session, continuing to outperform gold in relative terms this week. The 10-year Treasury yield jumped 5 basis points to 4.657% in the hours after Wednesday's decision, while the 2-year yield actually slid 4 basis points to 4.236%. An unusual divergence that tells you the market is uncertain about the near term but still pricing serious long-run inflation risk. Crude oil is a critical piece of this picture, with West Texas Intermediate hovering near $81.50 a barrel and Brent below $85, both still up more than 20% for the month of July because of the ongoing conflict between the United States and Iran. CME Group's FedWatch tool is now pricing roughly a 63% probability of a rate hike, not a cut, at the September meeting, a number that would have sounded absurd to most economists 12 months ago. None of this happened in isolation. And to understand it, you have to trace the chain link by link, the way you would trace a fault back through a power grid to find the transformer that actually failed. The originating stress is the Iran conflict, and this only makes sense once you understand that oil is not just an energy input, it is an inflation input that the Fed cannot ignore. Renewed hostilities in the Middle East pushed crude up more than 20% in a single month. And that spike works its way into transportation costs, into manufacturing costs, and eventually into the core inflation prints that the Fed watches every 6 weeks. Before we get to the consequence for silver, we need to understand the cause inside the Fed itself, because Chair Kevin Warsh, now in his second meeting leading the committee, has deliberately stripped out the forward guidance language that used to soften these transitions. That means the market gets less warning before policy shifts, which is exactly why Wednesday's press conference triggered a genuine risk-off reaction, with the Dow falling more than 840 points, or about 1.6%, while the S&P 500 slid roughly 0.6%, and the Nasdaq gave back about 0.5%. Once inflation stays elevated because of an energy shock rather than a demand boom, the Fed faces a structurally different choice than a normal cutting cycle, because cutting into an oil-driven inflation spike risks unanchoring expectations entirely. That is precisely why Hammack, Kashkari, and Logan broke from the majority, and their dissent is not noise. It is a signal that a meaningful bloc inside the Fed now believes 3.50 to 3.75% is not restrictive enough given where energy and headline inflation are sitting. This only makes sense once you connect it to the June dot plot, which quietly raised the median year-end 2026 projection to a range of 3.6 to 4.1%, up from the previous 3.25 to 3.75%, meaning the committee's own internal expectation has shifted toward higher, not lower, terminal rates. For gold, higher real yields are traditionally a headwind because gold pays no interest, and every basis point the 10-year yield climbs raises the opportunity cost of holding it. But gold is only down 0.42% today, not sharply lower, and that is because of a second force working against the dollar, with Japan suspected of intervening in currency markets again to defend the yen, weakening the dollar and offsetting some of the yield pressure on gold. Silver behaves differently in the same chain, because on top of everything gold responds to, silver carries genuine industrial demand from solar manufacturing, electric vehicles, and data center build-out, so tightening COMEX and CME warehouse inventories can push silver higher even in a week when gold is soft, which is exactly what we are watching happen right now. Here is what most mainstream coverage is getting wrong about this decision. Almost every headline this week framed the story as simply Fed holds, metals react, as if this were a routine pause like the 4 holds that preceded it this year. It is not, because a unified hawkish dissent from 3 regional presidents has not happened since 2016, and that changes the character of the risk entirely. From will the Fed ease enough to will the Fed have to reverse course and tighten into an energy shock it did not choose. The part almost nobody is talking about is what this means structurally for gold's floor, because the World Gold Council's central bank survey has shown sustained multi-year buying from official institutions that is largely indifferent to short-term Fed policy, and that buying does not stop because Cleveland's Fed president wants a quarter-point hike. At the same time, S&P Global's mine cost data shows that all-in sustaining costs for primary silver production have climbed enough that a meaningful share of global mine supply becomes uneconomic, well above where silver traded even 2 years ago, which puts a structural floor under price that most retail commentary never mentions, because it requires actually reading the cost curve data instead of the headline. If you found that distinction useful, the kind of thing you will not get from a 5-minute market recap, this is exactly the level of analysis I try to bring every time the Fed, COMEX positioning, or central bank flows shift the picture for gold and silver. Subscribing means you are not reacting to these moves after the fact. You are already positioned to understand them the moment the data drops, whether that is the September FOMC statement or the next Silver Institute supply update. I read the comments on every video, and the people who ask the sharpest follow-up questions are usually the ones who end up understanding this market better than most of what gets published in mainstream finance coverage. Now, I want you to sit with something more uncomfortable than a price chart. There are two versions of you holding a position in gold or silver right now. One version has a clear thesis, understands specifically which data points would prove that thesis wrong, and would calmly reduce or exit the position if September's inflation print or the FOMC statement contradicted it. The other version bought because the chart was going up, cannot articulate what would actually change their mind, and is quietly hoping the next Fed meeting bails them out because they have too much riding on being right. Both versions can hold the exact same ounces of the exact same metal, but only one of them is actually managing risk, and the market has an uncomfortable way of eventually revealing which version you really are, usually at the worst possible moment. This is not about being bullish or bearish. It is about whether you can name right now out loud the specific condition that would make you sell. With that in mind, here are 3 ways this resolves between now and the next major data points. In the first scenario, inflation cools before the September 15th and 16th FOMC meeting. Oil retreats as the Iran conflict de-escalates, and Warsh's committee holds again, in which case the descent fades, real yields ease, and gold could work toward $4,300 to $4,500, while silver pushes toward $65 to $70. In the second scenario, the hawks win the argument, core inflation stays sticky into September, and the committee delivers the hike Hammack, Kashkari, and Logan wanted, in which case the dollar strengthens, real yields climb, and gold could pull back toward $3,800 to $3,150, while silver, cushioned by industrial tightness, holds near $52 to $57. In the third scenario, the Iran conflict escalates rather than cools, oil pushes above $90 a barrel, and the Fed is caught between an inflation shock it cannot control and an economy it does not want to choke, in which case gold could see the strongest move of the 3 toward $4,600 or higher as safe haven demand overwhelms the yield calculus, with silver following but more volatile. I'm not going to tell you which of these is more likely, because the honest answer is that the data between now and the September meeting, including Chair Warsh's remarks at the Jackson Hole Symposium in August, will tell us which path this market actually takes. So here's the question I want you to sit with, and I genuinely mean sit with, not answer in one line in the comments and move on. If you knew with certainty that gold and silver would be flat, exactly where they are today, 3 years from now, would you still want to own them? And if the honest answer is no, what does that tell you about whether you are actually investing in this market or just speculating on the next headline? Leave your answer in the comments. I read them, and the conversation that question tends to start is usually more valuable than anything I could put in the video itself. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.